Hi, so this is my forecast for 2019 growth in real GDP for the U.S., global economy, as well as how that's going to impact the S&P 500 and equity prices, as well as volatility. I also have a forecast for the crude market as well as the Federal Reserve and where I think the rate hiking cycle is going to be for 2019 as well as 2020. And then also I discussed the 10-year Treasury yield and have a forecast for that, as well as how that is going to be impacted by the twin deficit, and also the reduction in the Fed's balance sheet, and sort of what kind of effect that's going to have on the market, private market participants being able to absorb those two flows coming from the Treasury and also the Fed. So the first thing I'll go into is the global GDP for 2019 and 2020. This is global GDP taken from IMF for the major areas involved. So GDP in the euro area is expected to be 1.9% in 2019, and for 2020 it's expected to be 1.7%. In Japan, it's for 2019 it's expected to be 1%, and in 2020 it's expected to be 0.4%, and in China it's expected to be in 2019 6.2%, and in 2020 5.8%. And if you include the U.S., those countries would make up about 50% of real GDP. My base case for 2019 for the U.S. is about 2%. The IMF has for 2020 about 1.7%. If you include all of those estimates for 2019, these countries are representing about 2.78% growth, which is sub 3% for all of them, and that's again 50% of worldwide real GDP. And in 2020, they're expected to drop to about 2.4% between all of them. So you can see that there's deceleration in the global economy expected for all of the major regions. So how do you? So I guess the next question would be, how do I come up with the numbers that I'm coming up with, and how do I come up with my base case scenario? So I follow some of the historic data that's out there, and so for real GDP, the first quarter in the U.S. is always the weakest. Historically, it's been extraordinarily weak. The second quarter is usually typically the best quarter in the U.S. for real GDP, and it's typically has the highest growth. The third quarter is typically maybe the second best in some years. Last year would have been a good example where the third quarter was the second best quarter. But the third quarter and the fourth quarter can sometimes be a little bit different, but we'll for historical purposes we'll say they're typically the same, typically, and so I use that to come up with some of the numbers that I decided to build my base case with. So for my base case in 2019, I think the first quarter is going to be 1.05% growth. The second quarter is going to be 2.8% growth. The third quarter is going to be 2.35% growth. And the fourth quarter is going to be 2.05% growth, which gives me a full year total of about 2.06% growth. And my base case for 2020, as you can see, that I assume that 2019 is going to decelerate from the 2.9% to 3% growth that we had in 2018 down to 2.06%. And then my base case is still deceleration into the first quarter, which represents the first negative quarter, which would be the 2020 quarter. I have as a base case of a negative 1% for real GDP and a negative 0.5% for real GDP for the second quarter of 2020. And then for the third quarter of 2020, I go back to trend growth, which is between 1.7 and 1.9% for both the third quarter and the fourth quarter, which gives me a full year total for base case in 2020 of 0.48%. So it drops from 3.3% in 2018 for real GDP in my base case to 2019 2.06% to 2020 base case of 0.48%. Historically speaking, GDP in the first quarter has been about 1.9%. Last year in 2018, it was about 2.2%. Second quarter historically has been 3.2%. Last year was 4.2%. Third quarter historically has been 2.7%. Last year, 2018 GDP was 3.4%. Fourth quarter was 2.7% historically, and then last year was about 2.6%. And so then I also created a worst case scenario. The worst case scenario assumes that for 2019 is full year total of about 1.34 GDP. which is substantially below trend. Trend being 1.7 to 1.9, almost a little bit under 2%. First quarter would be the worst quarter, which would be 0.5%. Second quarter would be the best quarter, which would be 2%. Third quarter, second best quarter, which would be 1.5%. Fourth quarter, third best quarter, would be 1.35%. And then if that were to happen in 2019, the worst case would create a substantially worse case in 2020, where the first quarter in 2020 would be negative 2% growth for real GDP. Then in the second quarter, it would be negative 1% growth for real GDP. And then we get a bounce back to 1.7% and back to trend growth, 1.7% for the third and fourth quarter, which would give me 0.1% for the full year for the worst case in 2020. So as you can see, the numbers are basically above trend in the base case scenario, with deceleration through 2019 in the second half, into deceleration for the first half of 2020, and then an acceleration accelerating into the second half of 2020 in Q3, Q4, which ultimately indicates that I think there's going to be more of a V-shaped recession. And I'll go into why I think that, because I think the recession for the U.S. is actually going to be a good thing, and I'll get into some of those details. So the base case for me is basically hinging on things that are going to add to GDP, like personal consumption is likely to carry the bulk of GDP, which is also going to have a negative effect on the U.S. trade deficit throughout the full year from Q1 to Q2 to Q3, Q4, and it's going to get substantially wider at some point. It's eventually going to peak. What that ultimately means is that U.S. households and businesses are going to be shouldering a substantial amount of global current account deficits, adjustments in general. So a better way to say that is that the U.S. consumer is going to be saddled with shouldering a substantial amount of current account adjustments throughout the course of the year, and eventually that creates a negative feedback loop. And at some point, and I'm thinking that that's probably going to be closer to Q3 and into Q4, it's going to have a negative feedback loop that ultimately feeds back into the U.S. economy, which creates that situation where we go into a negative first quarter of 2020 and a negative second quarter of 2020 in terms of real GDP growth. However, there are some benefits to that, and part of that is the U.S. position as an energy powerhouse. So what will ultimately happen in the third quarter and fourth quarter of 2019, we should see the U.S. currency adjust, and the dollar weakness will allow the U.S. economy to shift from being driven by domestic growth into the U.S. export sector, where the U.S. currently, and for the foreseeable future, for at least the next 5 years, has a very large competitive advantage in exporting energy. We're an energy powerhouse. So the weakness in the dollar from the third quarter in 2019 all the way through the first and second quarter of 2020 will be substantially beneficial in terms of rejiggering the U.S. economy from consumption-led growth over the last 10 years during the economic expansion to switching over to the export-led growth, and allowing us to probably balance out a little bit better going forward into 2020. So the domestic rebalancing in the U.S. will limit the pressure in 2020 on U.S. households, businesses, and it will slow import growth. Now, things that will also add to GDP during 2019 is definitely going to be non-residential fixed investment via pipelines and oil rigs. They will definitely probably add to GDP substantially through 2019. And again, I'll go into that topic when I go into the crude oil market forecast that I have, and kind of try to relate all those topics. And then also when I talk about the price of where the S&P is going to be in the market in general. And also some of the emerging market themes that I have as well that I'll discuss later. So also government spending will add to GDP in the first quarter, even with the shutdown, and also into the second quarter. However, in the third quarter and fourth quarter, the effects of the government stimulus from the tax cuts in 2018 will start to slowly fade out and eventually become null and void. They'll be non-existent. So if you think about the Trump administration, ultimately they had a three-pronged arrow in terms of what they wanted to accomplish, with one, deregulation being the first part of the arrow, the second arrow being tax cuts, and then the third arrow would be infrastructure spending. And so what I think is very likely with infrastructure spending has to do with kind of where we are right now in the government cycle in terms of the 2019 budget, which we haven't approved yet, and ultimately they'll have a continuing resolution that they agree to. They'll eventually roll the remaining appropriations bills into a gigantic, what's called an omnibus spending package. They'll pass that through probably in February or March, and then they'll start to focus on the 2020 budget. But I think the third arrow, which the Trump administration wanted to get out there, which was infrastructure spending, is not likely to happen because they're not going to be able to agree to that in Congress because of the twin deficit and the budget deficit and those things. But also, the labor force is probably at full capacity, so we don't have a lot of additional slack capacity in the labor market to drag people back into the labor pool. Drag people back into the labor market and put them to work in terms of creating a very gigantic infrastructure program. So we're running a little bit short in that area. So the availability of workers to pull in is going to be a problem for any construction projects going forward. Now, things that are going to continuously take away from GDP throughout 2019. Net exports, and net exports are going to substantially take away due to what I said earlier about U.S. households and businesses continuing to shoulder a substantial amount of current account adjustments, and that's through the import sector. And eventually that has a negative feedback loop. And part of that happens through basically two ways. One, the appreciation of the U.S. dollar in Q1 and Q2, which is a reflection of the position of the U.S. consumer being the strongest in the world at this point in time, and also the weakness in our trading partners. So the U.S. dollar has to appreciate at least for the first quarter and into the second quarter. The fact is that the U.S. consumer is going to be taking in a lot of imports from our weaker traded partners because they're not growing as fast as we are at this point in time, and that's sort of kind of where the feedback loop happens. So, you know, when you say that the U.S. consumer is going to have to absorb a substantial amount of current account imbalances, that's where they absorb it through the appreciation of the U.S. dollar, and they'll keep consuming. At some point, and I think it's going to be in 2019 Q3. The U.S. consumer is going to hit its peak ability to consume goods. So the other thing that's probably going to take away from GDP, real GDP growth, is going to be residential investment, and that's also, you know, that you can make the argument too that in the second quarter, you know, depending on where interest rates are and where asset prices continue to rise, but interest rates may be substantially low if inflation were to remain. Inflation and inflation expectations were to remain fairly benign going into Q3 and Q3, going into Q2 and Q3. But I have a crude oil outlook that I think is going to happen and play out in April. That's going to change that situation where inflation expectations may actually change throughout the year into Q3 and Q4. Some of that has to do with what could possibly happen with tariffs later in the year. Like I said, again, the U.S. consumer is going to be driving a lot of that, and corporations may be in a position where they decide to pass on some of the cost over to the U.S. consumer, which again ultimately involves and moves the U.S. consumer into being into that feedback loop that pushes us into the negative GDP for the first quarter of 2020 and the second quarter of 2020. So ultimately, the other thing that I think is going to take away from real GDP in 2019 is going to be the buildup in inventories in Q3. Typically, inventories build during Q3 ahead and in anticipation of the Q4 holiday selling seasons. But because of what I think is going to be a weaker and a slower GDP throughout the second half of 2019, I think that's going to have an impact because companies are probably going to overbuild. So in Q3, it's probably going to have a positive effect on the economy as they build those inventories. But ultimately, after Q3 into Q4 2019 and into Q1 2020 and into Q2 2020, that inventory build is going to have a dragging effect on real GDP. So it will have a dragging effect probably in the fourth quarter of 2019. So that's kind of how I came to the conclusion of where I think the market's going to be and how real GDP is going to be and how I built my base case. And a lot of that has to do with just in general, how did I pick the base case for 2020? A lot of that had to do with those high level factors that influence real GDP. Like the U.S. currently is in a situation where low fertility rates and high mortality rates from 2020 to 2030 are likely to play out over the course of the next decade. And also we suffer from low immigration and declining trend that's been going on for almost a decade. And also, we suffer from very low productivity, and so we're unable to increase productivity at a rate that we can actually increase GDP sustainably. And again, it goes back into that low fertility rate influencing how slow growth in the working age population influences labor. And then the other thing too is that hours worked reaching peak at some point during 2019 is going to be a factor. So all of these are likely to lead to slower GDP growth in 2020 through 2021 and onward. So that's sort of how I got to the conclusion, and those are the main things to kind of sort of think about. So in the next or in the next video, I'll talk about how this will affect the equity market, as well as how it's going to affect the Fed's policy decisions and how this may impact emerging markets, as well as how it's going to affect the crude market and commodity market, and also what effect the twin deficit, given my forecast for base case GDP, is going to affect the U.S. Treasury's ability to have private investors absorb a very large issuance, and sort of how the trade deficit and the strength in the U.S. consumer plays into that. And then also the strength of the U.S. dollar as well in the first half of the year. So stay tuned and listen to what I have to say.